Hey guys, it's me again, back again with another video. This is actually the intro to technical analysis. You can actually go ahead and follow me on MarketWatchFX, follow me on Instagram, and also on Facebook, okay? What to expect on this video, a brief idea about what is Forex, Forex Essentials Part 1, which is the three types of charts, how to read a price chart, and the idea of supply and demand. So, what is Forex and what is technical analysis? Obviously, Forex is the trading of money, and technical analysis is the study of price movement via chart analysis. So, all you're really doing is determining past price to build a case for future price movement. Okay, what is Forex based off of? It's based off of supply and demand in theory. Supply represents how much the market can offer, and then demand also refers to how much quantity of product or service is desired by the buyers. This creates sort of like a rubber band effect where a price bounces when it's too high or too low. What is Forex based off of in regards to supply and demand? A good like theory that can describe the market is something called the Wyckoff's theory. And this is actually one of my favorite theories because it describes the four major stages in the market. And the goal is to actually find two out of four. You're not looking for the accumulation, you're not looking for the distribution, but you're looking for those markups and those markdowns in those accumulation and distribution phases. So, trader tip, I always wrote this down for a lot of people that are new. If the market is waiting up for a push towards the upside or the downside, there will always be some type of reversal pattern, spike, or market movement to trap speculators before marking up or marking down. Okay? Wyckoff's theory continued. So right here, you could actually refer to something called stockcharts.com for a more explained uh, understanding about the Wyckoff's theory. But these are just two price charts that actually show the phases. If you look to your left, this is more of a simple chart that you could just jot down for your notes. Obviously, right over here, let me see if I can get my pointer. Okay. So right over here, this is the accumulation area where the market's typically oversold. And then there's going to be some type of pattern in this area where it's going to determine the reversal for a markup. And once it hits the distribution area, it's just building a case or building some type of reversal pattern for it to go towards the downside. So therefore, essentially, it's supply and demand in nature. Like I said, rubber band effect. And if you look right, this is more of a detailed explanation. And this is why I actually specifically say that there's always some type of reversal pattern. Because during the accumulation phase, what do you see? You see one, two, three touches. You see a zone. This can typically be maybe a head and shoulders or double top, double bottom, whatever you would like to see. And then there's some type of markup with higher highs, higher lows, and then the distribution, once again, some type of reversal pattern, and then the markdown phase, which is lower highs and lower lows. Sorry about that. Tongue twister. Three types of charts. So basically, there are essentially three types of charts. One is the line chart, the bar chart, and the candlestick chart. So the line chart is more for seeing price movement. It doesn't really show a lot of information. What is very critical because you can see a lot of patterns, such as head and shoulders, double top, double bottom, etc. As for bar charts, it's a little bit more advanced, and it depicts what is a bull and what is a bear. Typically, the red is when the market's going down, and the green is when the market's going up. And this market is obviously showing uh, higher lows and higher highs. Okay, and then the candlestick chart. This is very essential. It's actually one of the most popular charts. I don't typically know why, because I really don't use them as often. I just started, but it's something that you can use to determine price because of the wicks and the size of the body of the candle, okay? How to read a price chart. So the price chart, um, I put this here in the slide because I feel that a lot of people are confused about reading the charts, okay? Everybody's like, oh, what is this chart actually saying? So there are three things that you can use to actually determine where price is going. You can use moving averages, which is something that is very easy because it smooths out all the static of the market, all these higher highs and higher lows, and just creates one average movement. So if you can, comment on the comment section where the market is going, up or down. Obviously up. So therefore, another thing with the moving averages is there's two moving averages. So therefore, there are crosses whenever there's some type of like convergence in price or some type of reversal. And the strength is determined by the distance between these lines. So the more far away these lines are, the more stronger the market is. The more closer the lines come to, the more weaker the market is and the more susceptible that it is to reversal patterns, okay? Okay, so another thing is down here on the x-axis, this is actually determining time, and on the y-axis, it determines the price fluctuation. So therefore, you can see the price moving up and down, up and down. This would be the markup. This would be the retracement. This will be the markup, retracement. Okay? And down below, this is actually the same chart, essentially. But this is actually describing the volume and momentum of the market. So therefore, it's very important, and just, if not just as important, because you know it's funny? A lot of people are correct about the market. I have an opinion that most of the time, most traders are correct. But because they don't use volume and because they don't use volatility, even though they're right, they may not have the momentum to drive the price down when they're right. So uh, you could take notes on the right of the screen. You know, these are actually key notes that you can actually implement into your strategies today, and they can actually help you in regards to improving you as a trader, okay? And next, what else is there? Um, like I said, looking at a chart, it's basically essentially a language. And what I mean by that is, um, at first when you see this, it's a little bit scary, but over time, the more you actually look at the charts and you analyze the charts and you see where the market's going, then the more stronger you will be as a trader, the more confident you'll be as a trader. And like I said, with the moving averages, it shows a strength of a buy. And then when it's ready to reverse, like a reverse over here, it started to reverse in the downside. But when this cross it was indicated, it was basically showing, hey, time to sell, time to change position. So at the end of the day, this is how you read a price chart in a sense, and this is like the fundamentals of reading a price chart. Okay, and what to expect in the next video. You can expect the overview of the sentiment analysis, technical analysis part 2, market structure, market support and resistance. And if you have any other questions, if you have any ideas about what should be added in the videos, you can always go ahead and subscribe. Okay? Have a great afternoon.